Well, let's just jump right into life insurance. Not a fun subject everyone likes to talk about, but something we must discuss in sound financial planning as you plan for a successful retirement. First, we need to talk about the basics of FEGLI. You see on your screen here we have the basic benefit, that is your annual pay rounded up to the next $1,000 plus $2,000. So if your annual pay were $71,285, your coverage would be $74,000. Now, this basic benefit of FEGLI comes with some extra coverage if you're under age 45. It doubles the amount of insurance if you're under 35, and from 36 to 45, the benefit decreases 10% per year until you're at age 45 and just the basic benefit applies. So that's FEGLI Basic. Now, on top of that, we have several other options. Option A comes with additional $10,000 worth of coverage if you choose it. Then option B has additional coverage 1 to 5 times your annual salary. Then option C has family insurance. You can get increments of $5,000 for your spouse up to $25,000 and increments of $2,500 for each child, a maximum amount per child of $12,500. Now, let's pull out your pay stub if you have one handy. Pull that out. I want to show on screen a copy of one. And if you will see under deductions, and we've actually circled it in a red circle on the screen, you'll see the word FEGLI and an amount under your current deductions. This is what you're currently paying for FEGLI. Now you have to watch. Sometimes you'll have FEGLI mentioned several times on this one document. You'll need to add those up and understand the different types of FEGLI. Many pay stubs have the word FEGLI optional, or sometimes it'll have the letter A or B or C, so you know the different components of FEGLI. But take a moment, have that pay stub, and make sure you understand the deductions and what's coming out. I'm about to do a quick math study for you, and you can do this on your own following my example if you'd like. So let's walk through a case study where we have someone making right at $100,000, having B times 5, the full amount of FEGLI possible on themselves. Now, the good thing about basic insurance is it will stay the same price throughout this whole scenario. Let's assume that you're somewhere between 50 and 54 years old. So again, basic's going to stay the same cost per pay period. Option B in that window of time, for the example that we have on the screen now, is $65 a pay period, meaning that the total cost of insurance in this example is $80 a pay period. Well, that's reasonable for someone between 50 and 54 years old. You possibly could get something better priced outside of the federal government, but it's not a bad price. But now have a 55th birthday in the federal government having FEGLI as your insurance coverage. Let's examine what happens. First, basic keeps the same pricing structure. In this example, it's still $15.30 per pay period. But option B jumps from $65 a pay period to $115 a pay period, meaning your biweekly cost is now $130 a pay period. That's a 62% increase just for turning 55 in this example. Now let's assume you didn't do anything again with your FEGLI and you kept it, and while employed turned 60. Let's look at the numbers. First, again, basic will stay the same at that $15.30. It doesn't change, assuming your salary stays the same. But option B will go from $115 to $260, giving a total cost of $275 per pay period. That's a 112% increase just because you went from being age 59 to being age 60. So be careful with your FEGLI while working. Make sure you examine the cost, understand if you should look at outside insurance and find a better price. FEGLI will continue to go up not only while you're working, but also in retirement. So I'm going to take just a moment and read for us as we turn our attention to FEGLI in retirement. I'm going to read for us from our newly published book, Navigating Your Federal Retirement, Your Successful Passage into Financial Freedom. We are so proud to have this book published for individuals. We've had a lot of good feedback already. It's just been out on Amazon for about the last month. Feel free to go out and pick up a copy. You can get it and read it on your Kindle if you enjoy that as well, but or get a hard copy and do what I do. I write in books whenever I'm reading them and make sure I make notes and highlights. This book is filled with practical information. The data that we're sharing with you today is in here, plus stories that help you apply what you're learning, so it's not just raw information. And I think you will enjoy that. So let me read just a paragraph for a moment as we talk about a transition into FEGLI in retirement. To carry FEGLI into retirement, you must retire on an immediate annuity, be insured on your retirement date, and have been enrolled in FEGLI either for the 5 years prior to retirement or since your first opportunity to enroll. If these conditions are not met, you are ineligible to carry FEGLI into retirement. Thankfully, FEGLI is not an all or nothing proposition. You can choose to keep only a portion of it if you desire in retirement. Upon retiring, you will need to decide whether to keep FEGLI, reduce it, or replace it. You'll have different choices for the basic benefit and the 3 options. Again, much more on this subject and many others in our new book. Now, let me summarize what I've just said for just a moment. I'll put them in bullet points on the screen for you now. You can carry FEGLI into retirement as long as you meet all of the following requirements. Retire on immediate annuity. You're insured on the retirement date, and you are enrolled in FEGLI for at least 5 years prior to retirement or since your first opportunity to enroll. And then at age 65, a death benefit and cost can depend on the options that you select. So let's look carefully at the options. I'm going to have to break apart FEGLI into its different pieces, basic and A and B and C for a moment, and assume you're stepping into retirement and examine those choices. As a refresher, just to pick up from where we left off, while you're working, here's what we see as the increase in FEGLI costs. You see it growing by the time you're 55 of $3,500. And now I'm just going to assume in this example that you retire at 60, and now we see FEGLI costs soaring up to $10,000 a year to keep all of that basic and those options intact as you step into retirement. Quite exorbitant, and for most federal employees, not something that can be manageable with the FEGLI cost increasing. So, how do you take it into retirement? What are your options? Well, let's break this down first into just the basic component. I know we're adding options A, B, and C together, but for the moment, we're just going to talk about the basic. Remember, it's your base pay rolled up, grown by $2,000. So let's assume in this example on the screen, you have $100,000 worth of FEGLI basic, and you can choose to take no reduction, a 50% reduction, or a 75% reduction of this $100,000 basic coverage. If you choose let's jump right to the best part. If you choose the 75% reduction, the price will stay the same, and in this example, you'll see $32.50. You'll still pay that monthly premium until you turn 65. And then from 65 forward, the insurance will be free. Now, we like that word, don't we? Free. But it comes with a catch. Your death benefit begins to reduce from that full amount down 2% per month until it's only worth 25% of its original value. That reduction comes into place at 65. It begins to tick down at age 65. But again, you don't pay any more premiums past 65. So if you are 60 years old or so and watching this video and you have FEGLI Basic, maybe you keep FEGLI Basic and maybe you consider the 75% reduction, because if you look back at this chart one more time, if you keep no reduction in FEGLI Basic, that amount of insurance could cost, in this example, $100,000 worth of coverage, cost you $226 a month. That's a hefty price. If you need life insurance, you need to make sure you're comparing FEGLI again to other options. Now, just in brief, I want to mention that you can choose continued options of FEGLI of A, B, and C into retirement, and those prices will increase every 5 years. It can be astounding when you actually look at the B increases, and eventually you could end up paying more for the life insurance than its actual value at your death. Just be careful, make sure you understand how those calculations work very carefully. If you choose this option A into retirement, the benefit automatically begins reducing at age 65. It reduces 2% per month until $2,500 remains, and the premiums stop at age 65. Not a bad benefit, very similar to the basic benefit. If we look at option B, it can be rather complicated. Again, as I've mentioned before, the very costly option. If you choose no reduction in B and C, the cost will rise every 5 years until age 80. At 80 and over, option B monthly premium is $5.20 per thousand. That's a lot of cost for insurance as you're looking forward. You can choose a full reduction of option B, and I'll show you on the screen what that looks like. You have premiums that stop at age 65, so you pay until that time and then you stop. But the benefit reduces 2% per month for 50 months until it's depleted. And again, that benefit won't begin reducing until you've turned 65. So you could have the full amount of option B from, let's say you retired at 63 for that 2 years before the reduction began. But again, be careful. Even to choose this, the cost can be quite high before age 65. Now, we need to have a conversation about how life insurance should work for you in planning for retirement. Let's go through a few key points here. Why should you carry FEGLI into retirement? That's the question you need to start with. Do you need life insurance? Do you have enough assets and enough income for you and your spouse or your loved one to make sure that you're cared for in the event of one of your deaths? For the federal employee, typically we see they are the lion's share of income in retirement. Just this morning I was talking with a couple and had that exact same discussion with them, and we showed, he was the federal employee, she's not. I showed him what if he passed away early and the difficult position she would be in if he retired, even leaving a survivor benefit. There would still be a significant decrease in income for her at his passing. And then she asked the question, the non-federal employee asked the question, what if I pass away? So I showed in the software her passing away, he was fine. Why? Because he's got the big pension. So do you need insurance? You need to make sure you answer that question around your retirement planning as a whole, specifically in your pension and ensuring your pension for your spouse. I find at this point, as you're getting pre-retirement ready, the bigger issue is not how much FEGLI do you keep or not, how much insurance do you need to make sure you're properly protecting your spouse, considering you have the primary source of income in retirement. So I want to make sure we address that. Do you need the FEGLI? How can you purchase additional FEGLI? Sometimes we get that question. If you are uninsurable in the marketplace, you can go through underwriting, and yes, there's an open enrollment coming for FEGLI as well, and you may be able to get in on some of those things and increase your FEGLI if you need it. Just make sure you're comparing other options, and you're, again, and as Abby said earlier, you are being a wise consumer as it relates to your insurance needs. You can get more about your life insurance needs from lifehappens.org. This is a nonprofit website where you can go in and plug in how much need you or your spouse may have if one of you passes away. If you have college planning expenses or a mortgage that'll be paid off, there's plenty of websites out there. I like this one because it seems fairly simple and clean and can help you determine how much insurance you may need later on in life.